The yield curve is a graph that shows the relationship between the interest rates and the maturity dates of different types of bonds. It is one of the most important indicators of the health and direction of the economy. I learned about the yield curve when I was studying finance in college. I was fascinated by how it could predict recessions, inflation, and growth cycles. I wanted to understand how it worked and how I could use it to make smart investment decisions. The yield curve can have different shapes depending on the expectations of the market participants. The most common shapes are normal, inverted, and flat. A normal yield curve is upward sloping, meaning that longer-term bonds have higher interest rates than shorter-term bonds. This reflects the fact that investors demand more compensation for lending money for longer periods of time, as they face more risks and uncertainties. An inverted yield curve is downward sloping, meaning that shorter-term bonds have higher interest rates than longer-term bonds. This is a rare and ominous sign that investors expect the economy to contract in the near future, and they prefer to lock in lower rates for longer terms rather than take a chance on higher rates for shorter terms. A flat yield curve is horizontal, meaning that there is little or no difference between the interest rates of different maturity dates. This indicates that investors are uncertain about the future direction of the economy, and they are indifferent between short-term and long-term bonds. The shape of the yield curve can change over time as new information and expectations enter the market. By observing these changes, I learned how to anticipate and react to different economic scenarios. I also learned how to avoid making costly mistakes by not swinging at the yield curve. One of the biggest challenges I faced in my journey to financial freedom was resisting the temptation of chasing high returns. You see, the market is full of noise and hype. There are always some stocks, funds, or strategies that promise to make you rich overnight. They sound so appealing and convincing, especially when you see other people making huge profits from them. But I learned the hard way that these opportunities are often too good to be true. They are based on speculation, not fundamentals. They are driven by emotions, not logic. They are subject to volatility, not stability. And they can quickly turn into losses, not gains. So how did I avoid falling into this trap? How did I stay focused on my long-term goals and not get distracted by short-term fluctuations? Here are some of the principles that helped me. I diversified my portfolio. I did not put all my eggs in one basket. I invested in different asset classes, sectors, and regions. This way, I reduced my risk and exposure to any single market event or trend. I followed a passive investing strategy. I did not try to time the market or pick individual winners. I used index funds and ETFs that tracked the performance of broad market indices. This way, I captured the average return of the market and avoided paying high fees and commissions. I rebalanced my portfolio regularly. I did not let my emotions or biases influence my decisions. I followed a disciplined and systematic approach to adjust my asset allocation according to my risk tolerance and time horizon. This way, I maintained my desired level of risk and return and avoided overreacting to market movements. I invested for the long term. I did not chase short-term gains or panic over short-term losses. I had a clear vision of what I wanted to achieve and why. I had a realistic plan of how much I needed to save and invest every month. And I stuck to it no matter what. This way, I benefited from the power of compounding and the magic of dollar-cost averaging. By following these principles, I was able to avoid the temptation of chasing high returns and focus on my long-term goals. And that's how I made a fortune by not swinging at the yield curve.